Plurilock Security a couple days ago reported Q1 2025 financial numbers. So in this video, I'm going to talk about the two most important things that I care about is gross profit and revenue from critical services. So if you can see, revenues for the Q1 increased quite a bit from the Q1 of last year, and gross profit reached $2.3 million. If you recall, the magic number, or the number that we are in a conversation about reaching cash flow neutral, is 2.5 million per quarter. It's probably going to be a little bit more, but that's the starting point. So the good part is they are getting close. Attention, attention, attention. This message is brought to you as a requirement by the British Columbia Securities Commission. In plain language, in a prominent spot, in a prominent fund, and designed to catch your attention, I would like to inform you that in case you are not able to see the screen and can only hear the audio, this video is disseminated on behalf of Plurilock Security. Second part is professional services or critical services. So if you recall, Plurilock Security is in the business, it's in the VAR business, reselling cybersecurity products, whether it's hardware or software from other companies, reselling them. But and that business tend to be lower margin business. And to drive gross profit and to drive margins, critical services is a service that they are targeting and growing to get them there. So in Q1, critical services was almost $4 million and gross profit margin was 12.2%. So I am super happy to see that 3.9 million, which is almost 4 million, because when we started this exercise, look where the professional services were. In 2021, they were $500,000. 2022, they were $742,000. In 2023, they were $2.7 million. And now in one quarter, they were $4 million or $3.9 million. Huge, huge growth. So on annual basis, I don't know if every quarter will be the same, but that would be like 16 million of professional services from this number. So this is a huge growth. So I'm very happy to see that. What I'm not happy to see that is, and by the way, these numbers here, this is old financials, because recently they had an auditor and they changed the accounting recognition. So these numbers are different, but this is what I wrote before. So I'm happy about the increase in gross profit margin. I'm happy about how professional services are growing super, super fast, and they represent more and more of the company's total revenues. When the exercise started, professional services were only about 1% of the total revenues. They got up to 4% in 2023, but now it's a different level, right? So this is what I'm happy about. What I'm not so happy about and impatient about is adjusted EBITDA. I want them to become as quickly EBITDA positive as possible. And in this quarter, we were adjusted EBITDA negative $1.2 million. It's going to take time, but I wish this happened faster. As this number, gross profit, continues to grow, they continue to scale the business, we're going to be getting closer and closer to that number, but I'm being impatient and I want it to happen faster. Now, I'm going to have you listen to the most important highlights from the conference call.
Before we get into the financials, I'd actually like to highlight a few trends in the evolving cybersecurity landscape. In the first quarter of 2025, we saw cyber threats escalate significantly, with an almost 50% increase in weekly attacks per organization and more than 120% rise in ransomware incidents compared to the prior year. Critical services, which we formally launched in February of 2024, has become a strategic priority due to its significantly higher margin profile and its ability to create long-lasting client relationships. Our critical services business grew 178% year over year to 3.9 million. This area of the business has been central to our strategy, and we intend to maintain focus here. Now, this focus aims to strengthen margins over time by expanding our revenue mix and building deeper recurring services relationships, and we're already seeing positive results. Now, Plurilock's recent wins are not just financial, they reflect our strategic position in the market. As threats become more sophisticated, customers are turning to partners who can deliver and implement advanced security solutions, and that's where we stand out. Partner-driven opportunities continue to support ongoing customer acquisition and service delivery. Our partnerships with leaders like CrowdStrike and ForcePoint help extend our reach, reinforce our credibility, and have already resulted in direct referrals and closed business. As we scale, our sales efforts are focused on higher margin offerings and supported by targeted tools and incentives. With stronger capabilities, deeper client ties, and growing recurring revenue, we're beginning to see a flywheel effect, momentum we expect to build as we carry out our 2025 strategy. In our effort to explore a possible listing or other corporate activities in the US, the company last year appointed new auditors, MNP, to streamline the process of doing an audit under both Canadian and US standards. Plurilock expects continued progress in our critical services business, supported by strong interest from both partners and customers. Following recent successful engagements, the company is experiencing a notable increase in word-of-mouth referrals and inbound inquiries. So the change in the business for us is that we've seen a very strong uptick in critical services, as we've talked about over the last several investor calls. And so where we've found the best kind of allocation of capital is towards the working capital for critical services.
What do you expect your burn rate to be for the balance of the year? And can you tie that into operating expenses at all?
Yeah, so I might look at this on an annualized basis. So in 2024, on a full year basis, what we saw as compared to 2023 was that OpEx was sort of in the 14 million-ish neighborhood. Gross profit grew year over year, but those lines did not yet intersect. What we're looking at for the balance of this year is we're very focused on margin expansion, which again, as we've talked about, the largest driver for that is going to be critical services. We also expect OpEx to decrease. And so some of the activities that we have in place, which includes leveraging some of our offshore hiring centers, as well, frankly, as adopting some of the initiatives around our own internal adoption of AI, we expect to be able to reduce the OpEx amount as well. The one thing that I would say for Q1 as compared to the balance of the year is we did front load some of the projects that we have. So for instance, we've talked about the PCAOB audit and some of the corporate activities that we wanted to do. And those expenses were landing in the first half of the year as opposed to the second. But they're not necessarily expenses that flow the full way through. So we were pretty intentional about wanting to make some specific investments in the first part of the year, and then we're also expecting some of those initiatives to bear fruit later on. So all that having been said, we're focused on growing margin, we're focused on reducing expense, and that's sort of how we see the remainder of the year. The flywheels are starting to spin when it comes to new client acquisition. So when we're looking at adding additional logos, we're seeing a lot more referrals and word of mouth coming inbound to us, as opposed to strictly focusing on existing client expansion. The importance is to have both. You always need to be adding new clients, and you always need to be hopefully expanding your wallet share within those clients. And the good news is that we are seeing both. I think the change this year versus last is that a lot of the investment that we've made in the partnerships, which we've talked about, like ForcePoint and CrowdStrike, are certainly we're certainly seeing the impact of those today. Now that we've been investing in them for a bit of time. in a lot of ways, the large OEMs like ForcePoint and CrowdStrike, they have great brand recognition, and they'll oftentimes uh, uh, be top of mind for customers. And so if a customer were to go to, let's say, a ForcePoint, just by way of example, because that's what the question had, ForcePoint might then turn around to us and say, "Hey, we need some help with XYZ part of the business." And it could be a direct opportunity in the sense that they might need help implementing and deploying ForcePoint, or it might be something that's a little bit more indirect. So perhaps the customer approached ForcePoint and they need a pen test, and ForcePoint doesn't necessarily do that themselves. They might refer that customer to us. And so having those partnerships in place allows those referrals or direct opportunities to come from those partners. And so that forms part of how we are going out and landing those new logos. So hopefully that provides a bit of an explanation.
Next one, what's your outlook on an uplisting? And there's two of them. And how are you positioning yourself to get that uplisting?
Yeah, so this kind of is in response to a press release that we'd put out last year, and in that press release we had talked about a desire to potentially access the U.S. capital markets, and we didn't put a timeline around that. We simply identified that the company is looking at alternatives, and the U.S. capital markets could certainly be one of those alternatives. What we have been doing in the background is laying the foundation such that if there is a window where we believed it made sense and would create shareholder value to uplist, that we would be able to do so. And so some of the things which we talked about both on this call as well as the last call has to do with making sure that our accounting practices are ready to go when it comes to forms that are acceptable to U.S. capital markets. And so specifically, we've referenced the PCAOB audit that we undertook, as well as other investments that we've made in the G&A function here at the company to be able to be in a position to do that. And we'll continue to lay the foundation while looking for opportunities to potentially act on that. I think that for us, a couple things have to come together. There has to be a route to potential uplist. There has to be a strategic rationale for that uplist. And that strategic rationale really comes down to whether we believe it's going to create more value for shareholders. And if those things look to be good, then it's something that we could certainly act on, and we'll be in a better position to be able to do so, having made these investments over the last 6 months.
What are your growth expectations for 2025?
Yeah, so for us, it's going to be a continuation of focus on critical services. I think that for a company like ours, it can be easy to just focus on top line revenue, and the way to do that is to over-index on the solutions division. Go after $1 million deals, but they might be fairly thin in terms of margins. And so for us, what we're looking for is growth overall, but specifically growth around gross margin. And the other thing that focusing on critical services does for us is also give us a vehicle to be able to focus on either recurring revenue or highly repeatable revenue. So we're going to continue to focus on critical services. We're going to continue to deliver on the existing clients that we have. We're going to continue to respond to incoming opportunities that we're starting to see come inbound as a result of the partnerships that we have and some of the foundations that we've been laid, or that we have laid. And that's going to be the story for the balance of the year.